Good afternoon. Today is April 29th, 2014, and welcome to our Ratio Call Spreads, a versatile strategy for diminishing volatility webinar. I'm Roy Weiler, the Director of Trading Operations for Time Leverage Capital. Let's first start with an important disclosure. Please be aware that trading futures, stocks, and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist.
You have to close the poll so I can show my screen.
Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Ratio Call Spreads, a versatile strategy for diminishing volatility webinar. Mr. Mueller.
Thank you, Roy. I hope everybody enjoyed the dulcet tones of my voice screaming across the trading floor. When you trade, you're used to making a lot of noise. So, and sometimes you have to get attention, as in the rest of life. Let's go ahead and have a quick look today. And we are going to be looking at a special program on the ratio call spread strategy that can work under different scenarios. So let's go ahead and have a look at the circumstances under which a ratio spread can be used. This is a very versatile strategy and is actually much more adaptable to a trading outlook than the strict inputs indicate. So let's first of all look at the direction and the expectations on our strategy grid. Again, ratio call spreads in most circumstances is deemed to be a bullish trade, and we're going to go ahead and review what those circumstances are. And again, it is a trade which is not only bullish in nature, but has an anticipation of diminishing volatility. So let's go ahead and have a look and see the particulars of a ratio call spread. And as you will find out, we can have multiple categories for ratio call spread in which the specifics of volatility, outlook, and direction can be adapted in accordance with price expectations. So let's have a look here. As you know, in the strategy gallery, we have the particulars of every strategy, in this particular on a ratio call spread. In this particular scenario, we are showing a long option that is purchased at, in, or closer to the money, and the sale of short options farther out of the money. And the feature of a ratio call spread instead of a bull call spread is that you do more than a one-to-one ratio. And we're going to actually look at this on a spreadsheet, which is going to make it much more clear. But what you have here is an indication of the visuals and the graph scenario, as well as the trade details. Bear in mind that in accordance with this design, the profit potential of a trade is limited to where the calls are written, and there is a risk scenario for the naked options, because when you do a ratio call spread, for every call that you write that does not have a corresponding covering call, that is a naked option, and you will see how that risk impacts a trade when we do a particular strategy. Today we are going to be looking at the soybean market, which has been fairly explosive and in which there's a fair amount of volatility. So it is because of the volatility and because of the various seasonal factors, as we have planting and other volatile periods potentially developing, we are looking at the soybean market. As you know, in our market section, you can get the particulars on the contract, the tick values, as well as links to primary and secondary sources where you can see some key items all of which in this particular scenario, as you can see, are specific to the soybeans and to the grain markets. Now let's go ahead and have a look at our advanced spread or futures options calculator, and we will be looking at two markets. We're going to be looking at a soybean ratio call spread, and we're going to look also at a S&P ratio call spread, in which the anticipation is for an up move, but for diminishing volatility for an up move. And let's go ahead. We've already saved these trades in the input section, so let's go ahead and have a look at the August soybeans and the particulars of the trade. As you can see, when we select the market here, the dialog box, the help box appears, which gives you the contract size along with a link to all of the particular contract specs. In this particular case, we are doing a call spread. We've input in the cost and the number of rows, and as you can see, in this particular scenario, we are purchasing one August call option, which at this moment is in the money. The futures market for August being settled at 14.20. So this option is in the money 23 cents, trading at 69. So there's still a fair amount of time premium there. And the seller is selling two calls, the second of which is naked, at $16 for a premium of 16. As you can see now, we're going to go to the particulars. By the way, anytime you need help with any definitions on these transactions, all you need to do is click on the box. And if you want information about strike price, the dialog box appears with the with an additional help tab, as well as when you want to check out premium. Again, an input box appears, so you can always intuitively go from section to section, as we've indicated before. Now let's have a look at the particulars of this trade. The purchase of the in-the-money August call is at a premium of 69. That premium is translated per the tick value into dollars and cents, so it's $3,450 to purchase the option. And on the sale of the two options at 16, there's a 16 premium collected. Of course, 16 times, again, we multiply it by the tick value, so those two would be collecting $1,600. So you said minus $3,450 plus $1,600 for a difference or a premium debit of $1,850. Then you factor in your transaction costs, and the initial outlay for this trade, including those commission costs for this layout, those transaction costs, is $1,955. As you can see, we have low break-even points on the futures and on the options, and high break-even points on the futures and on the options. So at expiration, the person who does this spread wants the market to be largely between $14.59 and $17.41. $14.59 to $17.41. When somebody looks at a chart on that market and they feel that that is a range within which the market should be at expiration, then they would be considering this trade. Again, bear in mind that the second option is naked, so we've indicated that the maximum loss or risk is at $12.50 per tick above 17.4009. Somebody thinks that this market can move to 17.4009 or beyond, then they would be more bullish than this trade anticipates, and they would have to adjust the trade accordingly, which can easily be done within the calculator, and we'll do an example of that. So right now, as you can see, no matter how large the drop is in this market, the maximum loss that can be incurred on a price drop is the initial outlay, the net outlay of premium, inclusive of costs. So whether soybeans go to $0 or they go to $5 or they go to $10 or they go to $12, if the purchaser of this spread does not offset or salvage premium, that is the maximum that can be lost on a drop, and not more. Ideally, somebody who trades in a spread like this, which is an August position, if they see the market not moving and erosion persists past a certain level, then they would be able, and they should attempt to offset the position before they incur the maximum loss. And again, on a drop, that loss is limited and predetermined. The sweet spot on the trade, as you can see, is right around where the 1600 calls are written. So the ideal precision expiration for this trade is at $16 or as close to it. So somebody who's looking at beans here, the market for August at 14.43. So given the target price of 16, this person is still pretty bullish, but thinks that the market is going to march there gradually, not explode there in 2 days. That's the falling volatility expiration. So this is a pretty bullish trade, which starts making money even at expiration around 14.64, which is not that far away. The market's at 14.43. So because of all of the premium collected, the trade does gain on a smaller move versus just purchasing an outright call. And unlike a futures, which would take a very large loss or could potentially take a very large loss on a drop, the losses are limited on a drop. So this is a person who sees some support, expects that the market is going to work its way up to 1460 and beyond, ideally as close to 1600 as possible. And as you can see, that naked option, the additional option that was sold, significantly reduces the level at which the long call can become profitable because of the money collected. So this is the old principle of collecting other people's money to try to improve your position. On the other hand, as we've indicated, if the market moves way explosively past this expectation of diminishing or falling or flat volatility, once the market exceeds past that break-even point, there's a loss of 1250. So if anybody here sees, you see these numbers and they can expand. Once we get to 1750, the break-even level and beyond, the losses can be pretty significant, and we can expand the output rows. Let's say we got 40 here, we can expand it to 60 and calculate the numbers there. And as you can see again, if you have any thought that this market could explosively and suddenly break to $18 or $18.50, the losses on this trade can become pretty significant on the naked option. On the other hand, if you're fairly confident that the market has got a cap on it at those levels and that it is bullish but with falling volatility, there is a fairly large sweet spot here with a good amount of time for this trade to materialize through the growing season and through the potential for adverse weather and other crises that could move the market. Again, be mindful that if on the two scenarios of loss one, which is the market falling, that you be mindful to salvage premium on the long option, which is a function of follow-up, and also on a rally, if it's a very significant rally, to be mindful of follow-up strategies on the second option or the naked option. And again, we are talking about from these levels, it would take a pretty significant move. The high break-even point is at 17, call it 1741. The market today closed at 1443. So we are looking at a move of almost $2 before that second naked option would begin to lose intrinsically more than the spread is making. The advantage to the trade is that you have a significant sweet spot in the middle that can work, and again, being mindful of drops to salvage if your bullish expectations are not met, and also to adjust if your bullish expectations are met but falling volatility expectations are not, because the bullishness is accompanied by a large move. One thing is that you do have a fair amount of room to look at this, and be sure to monitor and use risk management at all steps, and certainly be sure that you have the risk tolerance on an explosive or surprising upside move to sustain that move. The second market that we are going to look at on a similar expectation is the S&P 500, and again, this is for somebody who is expecting a moderate upside move, and not an explosive upside move, and the potential for a pretty significant drop. And this trade, unlike the first one, is less bullish. It's anticipating a smaller upside move with rising volatility and incurs a much smaller loss if the market drops. So let's say if somebody thought, well, I think this market could go up, I want to participate in the S&P, which is presently at 1872. And I want to press participate, but I don't think it's really going to go very far. So they don't want to invest a lot of money in a bullish move, but there's some desire to participate with a sense there's a fairly strong top in place. So we have selected, and obviously different rationale can create different chart points, the purchase of an 1850 call, which is in the money. Presently the market's above that, so at 73. Some of that value is intrinsic value. And then finally, and for those of you who want to get a better understanding of in, at, and out of the money options, be sure to check our frequently asked questions section, as well as our reference materials, where you will have descriptions and videos of all of these items in greater detail. So here we are looking at a scenario, and let's go right to we see the particulars of the trade. Purchasing at 1850, selling 2, so the second one's a naked call, at 1920. The premium paid is 73. The premium collected is 35 times 2. And this is how that translates into dollars and cents. Spending 18,250, collecting 17.5 for a difference, or a debit of 750, plus transaction costs, which have been input from the first screen, gives this trade a total debit of 855. That means, as you will see, that on any drop, no matter how large the drop, the maximum that this position can lose is 855, and that's assuming that the purchaser of this spread does not come out of the trade before expiration and salvage any premium. And again, part of monitoring the trade, especially that we're looking at the September transaction, is to monitor the time values and the premium, and if the market does not go your way, to minimize the risk on this side by offsetting the position early. Let's look at some low break-even points. A low break-even point on this trade is 1853.42. So although this is a bullish/flat trade, as you can see, the market, if the market stays flat, this transaction, because it costs so little due to premium collected, can actually make some money in a flat market. It can afford to actually drop to 1853.42 by expiration, and because of the small amount paid, it would still be up on premium, again due to the premium collected on the outs of the money options. And of course, the break-even point on this position would be the 342. Let's go ahead now and have a look at the risk scenario. Again, because it's a ratio call spread, there's a second naked option sold. Once the intrinsic value and the gains on the spread are overcome by the second call, there will be a loss of $25 per tick move above 1986. We're talking here about almost 2,000 on the S&P, so clearly for somebody to be concerned about this trade, number one, it would be because of the possibility of margin, but it would also be that this person does not contemplate the market to find its way that significantly above 1900 and that close to 2000 on the S&P. Let's look in again. These trades can be adjusted accordingly. As you can see, no matter how much the S&P drops, person who speculated with their total of 855 on this trade and doesn't adjust and doesn't offset, the most that person can lose is 855 without salvaging. On the other hand, as you can see, there's a very significant sweet spot here. So if the market, even at 1859, which is below where the market is now, the person can pick up 1395. And as you can see, the numbers continue to increase. Right now, that market, September is at 1865.75. So very simply stated, even if this market between now and expiration dithers around, goes up, goes down, but ends up lower than it is right now because of the amount of premium collected and the purchase of in the money option, this position at expiration would still be worth almost $1,400 intrinsically, or it will have profited $1,400 intrinsically on very small moves to 1860, 1886, 1895, 1900, which are not so far away if the market just kind of holds in this range or moves up some into expiration. As you can see, some of the gains can be very significant in this sweet spot, in this range, and that's why it's called the option ranger. You want to see if this particular range makes sense to you. On the other hand, as we indicated previously, if the market does break out to the upside, there's a second naked option there, and as you can see here, the losses begin. So for instance, should the market break out and find its way above 1890, let's say at 1894, now there would be a loss of 1855, and the numbers increase tick by tick on the move up. Again, some people may think that some of these upside numbers look absurd, but if your budget and your riskability is not there for these types of losses, and the likelihood of the event is not sufficient to get somebody in there, because you have to be able to withstand significant surprises in the market in order to be profitable. On the other hand, as you can see, there's a pretty big sweet spot to where below the market is right now. As I indicated before, we're looking around 1865, and this trade is profitable between 1853 and 1986, which is a pretty big range at expiration. For those who would be looking at a spread like this, for argument's sake, and let's say they would say, well, you know, I really, I'm looking at the spread, and I really don't think the market's going to go up that much. Maybe I want to do this trade at a credit. They might turn around and say, well, let me just go ahead instead and sell the 1900 calls and see if I can collect more money. So if we were to do that, again, it's very easy to change figures in the option range. You just change that to 1900. Let's say the premium on this, there's a bid and ask at 43.5, 44.5. So let's say the premium there is 44. This trade would now be a credit. Let's go ahead and do the calculation. Everything else changes in line with the spread, and now you get to see if your sweet spot looks a little better than it did before. And let's see, we've got the 1850 at 73, we've got the 1900 at 44, and let's see the cost of the transaction. Okay. Alrighty then. We would be, on this particular transaction, spending 73 points is the equivalent of 18,250, and collecting the 4 would be 22. So the net credit on this trade, this would be a credit trade, totally having a different look as a ratio call spread, because in this particular scenario, having collected a credit of 36.45 after costs, no matter how far the market drops, this trade, assuming no early offset, would keep the net premium collected. So if the market stays flat or it drops, as you can see, no matter how far it drops, that initial credit collected of 36.45 is kept. So this can literally be a bearish to flat to slightly bullish trade with an anticipation of diminishing volatility to the upside, or maybe falling volatility to the downside. And if you look at it, let me increase the number of rows. To 70 rows. Again, on the drop, the numbers are the same no matter what. On any drop of any size, as long as the market expires below its break-even levels, there's a total of 36.45 to be made. On the other hand, if the market ends up, again, without huge volatility, going up somewhat into its sweet spot, and it's been lowered to 1900, so 1900 is the ideal expiration where the position would make its maximum gains of 15,645 at 1898. And then as you can see, as the numbers go up because of the naked option, the second naked option, the profits diminish all the way to almost 1960. So for anybody who thinks this market's going to end up around 1964 or below, or let's look at the high break-even point of 1964.58, this trade essentially would make money anywhere below 1964.58 expiration, with the most to be made close to the 1900 level, and essentially a very large cushion on a drop, because no matter how large the drop, so this is actually a trade that can be bearish, it can be flat, or it can be moderately bullish with rising volatility, because it does have coverage to, as we've indicated before, to the high break-even point of 1964.58, which, as you know, is 100 points away. So if the S&P does not rally 100 points between now and expiration, to one degree or another, this trade would be profitable. And again, this is the difference when you look at two trades going back and forth between the initial trade that we demonstrated, which was at a small debit, where there can be a loss on the drop. By fine-tuning the numbers and looking at the next level, for somebody who also thinks this market could go down, be flat, or be slightly bullish, assuming the risk tolerance is there, this would be a trade that would be indicated by the calculations based on intrinsic values. And finally, let's go ahead and have a look for somebody who wants to look at this trade at a lower level of risk. As you are aware, there are various contracts to be used, the E-minis, the mini contracts, as well as the full-size contracts are included in the calculator, so that we can easily assess the values as we go through. And as you look here, again, on the E-mini contract, using the 1850-1920 spread that we showed on the large contract, we would have a net difference of 150 plus transaction cost, so the total cost of this trade would be 255. And again, as you can see, no matter how much the market drops in this scenario, that is the maximum that would be lost on a drop, even a significant drop, unless the person who purchases the spread salvages. And obviously on a drop with options written out of the money, one would have to monitor premiums closely and hopefully come out without incurring that loss. The sweet spot is as before, and as you can see, again, we have a sweet spot here for a pretty significant move, and then if the market breaks out beyond that, just as the profit range here shows smaller profits, it's a smaller contract, so it's less profit potential. On the other hand, as you can see, when the market breaks out to the upside, there's less tick-for-tick loss on the naked option, and on a drop, there's also a smaller loss because there was a smaller outlay. Again, if you were to look at this trade and again say, well, let's see how this looks on the E-mini, making the same adjustment of selling the 1900 put, and then we would go ahead and do the calculation. So it's very easy to take a saved trade and model out different values. Now, as you can see, no matter how low the market drops, there's a smaller gain, and yet a very nice gain of 645, regardless of how low the market drops, because that is the premium collected. And unless the market breaks out against the second naked call significantly, the gain is there again, close to the 1960 level. And as you can see, with a sweet spot in this particular case, right around 1900, where this spread can actually gain over $2,700, close to $2,800. On a move to 1900, which is a relatively small move, again, because of the low cost of the trade. The low cost of the trade is because of the premium collected, and the trade-off against the low cost and the wide potential is that if the market does break out significantly, there is that second naked call that made the trade cheaper that we would have to deal with on a rally. Again, that being a naked option, and we indicate again that the risk above that level is 1250. If anybody feels the markets can break out significantly beyond 1963, then they would have to consider a different trade, perhaps write options farther out of the money, or not do the trade as a ratio trade. Again, this trade is for a down, flat, or slightly up market. It gives a big range of profitability from 0 to 1962.90 at expiration, with an ideal expectation or target of 1900 on the S&P. So these are some of the examples. Are there any other questions? Are there any questions that have gotten in on some of these examples?
Ken, they're asking what happens if you sell more than 2 options?
Well, that's actually a very good question. A trade is still a ratio call spread, but what happens is that the debits and the credits change, and the convenience of the calculator is that you can assess those changes in the trade. So let's go ahead and take the S&P example that we've just viewed in the E-mini, and then we're going to do one in the soybeans as well. So let's say now, for argument's sake, that we're going to go back and somebody says, well, you know, let's see what happens if I go back to my initial trade that I checked out, the S&P 500 E-mini ratio call spread, and let's say we go back to that and we look at the 1850, 1920. So now we brought that trade back. As you recall, maybe somebody says, you know what, if the market drops really hard, I want to make money. I don't think this market's really going past 1900 or 1920. So they might say, I can handle a little bit of margin, but I want to make money if the market goes down, not lose money. So one of their options is to write an additional naked call that would turn this trade into a 1/3. All the other values stay the same. Again, once we put a trade, it's very easy to calculate different levels and compare different combinations of strike prices and premiums. And now, as you can see, in this particular scenario, having bought 1 but sold 3, the trade comes in as a credit of $1,600, and then after transaction costs of $1,460. Now, there is a loss of $25 per tick move above 1969, so a person should be fairly comfortable that this market's not going to run high, much higher with rising volatility, and that rather that the market is going to be up moderately, flat, or down. So in this particular scenario, we also have a maximum profit that is limited to $49.60 because of the options that we wrote. And more than anything, let's look at where the spreadsheet shows us. Again, because of the extra options sold, if the market stays flat or if it goes down, certainly if it goes down, if it goes to 0 or whatever number, the initial credit collected can be kept. So a person who wants to be bearish this market or thinks there's a chance of a significant drop, along with a chance of a flat or slightly up market, this would enable them to take advantage and gain, although this is, in theory, a bullish trade looking for falling volatility. In fact, this trade, with the right composition, can actually also fulfill the expectations of somebody who's bearish. And now let's have a look. The market in this particular scenario, the ideal expiration is at 1920, where this particular trade, as we indicated before, would make a maximum of $49.60. And then it has a pretty good margin of error, as we know, all the way to the 1969.6. And here we can just literally look at intrinsic value at expiration and see that if the market goes up, if it gets to 1900, 1920, 1940, 1960, at expiration, intrinsically, this is all a margin of error to gain because of the long premium collected, of course. And here's the risk, because there's not just one second option, but 2 naked options. The increase per tick now is a loss of $12.50 per tick value above that particular level. And as you can see, if the market breaks out in a bigger way than in the 1/2, once we hit some of these higher levels, 1976, 1980, 2000, and on, there would be 2 options that are naked. So the losses can get larger into margin, again, on the move past these levels. So anybody who puts on this trade, which may look very appealing to some, especially if they think the market's going to hold in this range, be down, be flat, or be moderately bullish, they also have to be in a position, in the event of some explosive, unexpected upside move, to handle these particular consequences and make adjustments on the naked options as needed. However, for his initial positioning, as you can see, this is the range of the trade, and one can do all kinds of combinations. For example, somebody can say, well, let me do this as a 2 by 5. And you calculate again. Literally everything else is the same, and you can fine-tune your numbers again here. There's a smaller credit of net of 1205. The maximum profit, again, now is it's a good number. It's 8205. The break-even is higher. It's at 1974, so this person has more room for an upside move. This trade is moderately more bullish than the last one. Less money kept on a drop. Still 1205 regardless of where the market drops. The break-even, again, is a little more, is at 1974, so there's more room of a rally to the upside, traded against less profit on a drop or a hard drop. The ideal level for profit is, the ideal is 8205.90, 8205.90, which a person can make if this market finds it at 1920, which is the ideal level. And you can see a lot of green, but things begin to reverse again at a higher level now. Instead of having to start worrying, the risk level has been moved up, because instead of a 1 by 3, this is a 2 by 5 combination. And again, one can continue adjusting based on level of bullishness or level of bearishness until they get what their sweet spot is, what their range is for being in the trade. And that's why the software is called the Option Ranger, because the person can literally take their goals, look at a chart, look at a forecast from a third-party analyst, and gradually decide to combine these numbers in whatever configuration of strike prices may work. So again, let's say somebody does this 2 by 5, and they say, you know what, let me go ahead and try that at the 1900 level, pay a premium of 44, and we've already seen those numbers. Very quick to do a calculation, and right away you're on, again, now this is a more narrow spread, so this person again has a different expectation, is a little less bullish, wants to make more money on the drop, so they lower this strike price, they collect more premium. Now the net difference after cost is 34.55, which makes sense for somebody who's more bearish, because if the market stays flat or it drops through the floor, they get to keep that credit of 34.55. And on a rally, as you can see here, the maximum that can be made is 84.55. And on the 84.55, they need to keep the market at expiration below 1956.37. So again, this is a bigger credit initially putting on the trade. The break-even point is lower in the contract, so instead of the previous numbers that we've seen, now the naked options intrinsically start taking away gains at 1956.37. And of course, you also monitor the premium, which in this case translates to 2403. Always monitor the premium. But again, somebody has to feel that their market's going to stay well below this level in order for the trade to be profitable. So again, here we have a margin of error that takes us to a pretty good range. And again, because there are a bunch of naked options, you have to be mindful. Let me increase the number of rows just to be clear on how those naked options would be impacting the spread on a rising volatility bullish move. Again, this is not looking for rising volatility, it's looking for falling volatility. And if you can see, for some reason, if this market breaks out to 2,000 or beyond, or certainly anywhere in this range where we get past the high break-even point, the losses can be pretty significant. Again, you monitor these trades, you adjust these options if you can as you go. But in order to write those naked options, you have to be mindful of the risk. So these are some of the ways of modeling different number of long options, different number of short options, different combinations, easily adjusting the strike prices, easily adjusting the premium levels. And if any trade makes a lot of sense to you, let's say somebody really loves this trade and wants to look at it, then all we need to do is save it under a tab. As you know, this is the S&P call ratio spread. I believe it's on the larger contract. We save it, and then we have it back on our tab here to refer back to any time. Do we have any other questions?
No, that you covered them.
Okay, thank you very much for attending. I hope that this was helpful to everybody. I certainly have some trade ideas that have been stimulated by looking at this, and I look forward to testing them out further. If anybody has any questions, please contact us, and if you want to review some of the terminology and the strategies, be sure to go to our reference materials where we have option sheets that'll give you definitions. We have a significant number of demo videos on how to input trades and also how these trades are designed in accordance with the strategy gallery. So you can check out all that information on your own and certainly be in contact with us if you have any questions. Thanks a lot for participating, and remember, knowledge is power, so you know, the more you know about trading, the better your position for making informed decisions. Again, congratulations for attending, and I look forward to seeing you all on the next one.